never entered a perfect trade just to get stopped out right before the real move happened. How did that feel? Now, in this video, I want us to break down the psychology behind the market maker's behavior. All right. And I want to show you exactly how the BTMM strategy helps you trade with them and not against them, and how you should position yourself for successful trade setups. So, for us to be able to crack the psychology behind the market maker's behavior, we need to ask ourselves a question. Who are these market makers? What are they? What do they do? And why do they actually manipulate the market? Why do they manipulate the price? Big question. So now, market makers are not just institutions. They are not just big banks. They are not just hedge funds or big companies, right? These are actually the engines behind the liquidity. The moment you're clicking those buy and sell buttons and your orders are being executed immediately. These market makers do not predict the price. And that is something that now you need to understand from today. If you didn't know, they do not predict the price. They create it. They know where the price is going next, all right? And what I mean is they create intentional levels. They know every trader who is looking at the market, they are seeing this support. They create this so that every time the market is coming here, you're buying, then all of a sudden they are going to go against it, right? And start going down. This is their behavior. It's their intention. That's what exactly what they want you to do. So, but for them to do it, one thing they need from you is your money. All right. The deposit that you put with your broker is of no use to them until the moment you're clicking those buy and sell buttons. That's the only moment they're going to own you, right? But if you prepare yourself, if you do the right thing, there is no way they are going to be your enemy. They will actually be your friends. One thing that we must understand from today is that they have goals, they have intentions, all right? They have objectives every day, every market move they are making. There is a reason behind it, all right? Now, one of the reasons is actually to collect liquidity. They want to go and hit a certain level where they can see buy limits, sell limits, stop losses, and all these orders. This is money to them. So they will come, trigger those orders, and then probably reverse the price because that is money to them. Probably, let's suppose we have 2.5 billion worth of money sitting here, right? And they know if they hit this level, they are going to get liquidity to push the prices down. Now, people usually think that because we have more buyers than sellers, the price is going to go up. Or maybe because we have more sellers than buyers, the price is going to go down. Now, I want to actually challenge you today. Think about it this way. I want us to be realistic today because they're in business, just like the way you open a supermarket and you're in business, you're trying to make money. All right. They make money by paying the minority and collecting money from the majority. And how does that happen? Now, look here. Let's assume this is a certain resistance level here, right? And there is 3 billion, right? There's 3 billion of people who are going short. All right. There's 3 billion of people who are going short. And then there's 1 billion of people who are going long, right? So this is resistance, remember. So it is expected that once the market hits here, it's going to sell. But remember, if there are 3 billion people or orders going down, or this is 3 billion worth of money going down, it means if they were to go down, they would lose this money. But if they were to go up, they would pay 1 billion and they would keep 3 minus 1, which they would have a net profit of 2 billion. So instead of this resistance being respected, it's going to be pushed higher. And so all those people who are selling here, considering this as a resistance, are going to lose. The market makers will always keep evaluating their book. They will always want to know what they are holding. Is it in profit or in loss? All right. Let's suppose the market is pushing up, going up, going up. So they know, of course, people are making money from this big bull run here. So if they're making money, what do? Let's suppose they're running out of float. They realize that probably they're holding 1 billion and they should be holding 2 billion. They will have to spike down, come all the way down, collect all these money from all these people who are buying. And then they have liquidity. That's where the spikes come from. Now, understanding the market maker psychology, and this is key for you. This is going to drive your decision making. It's going to help you know what to do and when to do it, right? So now, one thing that you must know, that market makers actually drive on real emotions. How they move you to make a decision and then make you feel you're wrong. All those things are what you call retail emotions. So one of them is fear of missing out. All right. So you feel like the market is going up. You need to execute an order because the market is pushing hard. The moment you execute that particular trade, the price pulls down. Fear of missing out. Because they issue you with aggressive candles and they make you now confirm that the market is going up. You enter the market. Once they have your money, they push the prices down. This is one of the reasons people lose money in the market. All right. So they issue big breakouts and news spikes. Right? So you see a big candle coming out of news, right? And then you're like, oh yeah, the market has confirmed it's going down. So you're going to execute yourself right here. Once you execute yourself and confirming that this candle was bearish, the next candle you see is even bigger than this one going up, right? This is what we call fake breakouts and new spikes. Then hope and revenge. This is one of the key things that you need to pay attention to, right? Do not come into the market hoping that you're going to make money. Come with the right skill. Equip yourself, right? Because this is where people lose money. You are trading based on hopes. They don't work in the market. What works in the market is skills. What works in the market is strategy, is management. All right. So they come and issue with an extended consolidation right here. Market consolidating. In between these two levels, they give you big candles going up, right? You execute your buy right from the wrong level, and then your stop loss below. The next candle that comes is one big candle, wipes your stop loss, then market comes back into the same range. Extended consolidations, just so that you can continue trading and losing your money. They know it's happening. And that's why they're extending it so that you can keep on losing your money back to the market, right? Panic stops. Let's suppose you have this as your setup. You know the market is supposed to go up. There is news at 3:30, right? And so because they know you are going long and you don't have all the money, so you must put your stop loss right here. What they're going to do, spike your stop loss and pull the market up and then continue going up. This is what we call a spike. So they collect your stop loss, they make sure you lose money, and then it starts going in your direction. Panic stops, so that in case you are right in the direction, you'll question your decision. If you don't know what you're doing in the market, you'll start questioning the decision that you took. And if you got stopped out, probably you'll even be freaked. Or maybe you will fear to enter the market again because you've been hit out, right? Confirmation bias. Assuming we are looking at a particular support right here, the market comes here, breaks it, then it retests, and then it gets a small candle going down, right? Now, remember, this is support. So they confirm that actually is a break and retest, and so you should go short, and your stop loss goes right there, right? Then all of a sudden, you get a big candle going up, and you're going to look at those examples. The market is just starts again pushing up, and you're wondering what actually happened here, right? That is confirmation bias, so that you can enter the trade in the wrong direction, and then just so that they can hold you at the most emotional extreme. Because if you're selling here and the market is pushing aggressively, you're being held at a wick. Let's suppose this is a candle. This is the wick. Your sell order is right here, and the market is going up aggressively against you. What would you do? Most likely, you're going to close your order manually, right? Because you're scared of what the market has done. So they wait for you to commit emotionally, and then they will reverse the market against you right at the level where you wouldn't expect. And this is normal for them. Now, I want to ask you a question. Look at this. So we can all agree that at this point, the market is bearish, right? The market is bearish, it's going down, comes back to the moving average, it taps it, and then we have these aggressive candles going down, right? The candles are going down. You in fact confirm, because the candle is volume, you're going to execute your sell right there. Your stop loss maybe will go right there, or right there, or right there. But then all of a sudden, the market, immediately you execute that sell, it reverses and it starts pushing up all the way to hitting your stop losses at every level that you can think of. They hit all those stop losses. But now there's one thing I want you to see here, something that probably many people don't notice. At the point when the market is reversing, at the point when they're about to go in the opposite direction, they always give you a confirmation candle in the opposite direction, right? They give you a sell candle, a candle that tells you we are going down, just for them immediately to reverse the market and start pushing up. Do you see this shift candle here? Imagine you have this as your confirmation candle to go short, or maybe this one, or maybe this one. But then all of a sudden, they are issuing a candle that is 2 times of the confirmation candle that you got. That is why it's important for you to pay attention to price action. Now, panic stops. Imagine, let's suppose you're looking at a certain key level, like this 200 EMA here, right? This is 200 EMA. They come and they pose around here. And so you're taking your buy positions here because you're seeing this as a support. But what they do, they keep sweeping. They keep hitting your stop losses. And look at it. You would have to place probably your stop losses, or maybe execute your orders at the most insane level. If this was to be considered, this big candle was to be considered as a breakout, then your sell would go right here, right? You sell right here, and then immediately they reverse the market with an equal opposite candle, right? And then they come and sweep your stop loss, and then they start consolidating around here. Probably if you now got attempted again to execute another trade, you enter the market, they give you confirmation they are going down, but they never break or take out the low. They just reverse the market and go up. Now from today, learn something. Change the way you approach the market. Change the way you see things in the market, because there's nothing else. So BTMM, it creates structures that actually exposes the market maker tricks. They help to show you where the market is playing games, all right? And it helps you to trade with the market makers and not against them. One of the things that you need to learn is about the 3-day cycle, the 3 pushes, the 3 levels, all right? How the market is played out in day 1, accumulation, manipulation, and stop hands, and even during distribution, right? In another video, we mentioned that actually the market moves in cycles. So once you have the market consolidate, and then they will give you a big formation low, right there. You execute your trade right here. They're going to give you 3 levels of rise. Level 1, pullback and consolidation. Level 2, pullback and consolidation. Level 3, and maybe prepare for reversal. This is now a normal market behavior, right? Every day, this is the same thing being repeated. Sometimes they will issue this in 3 days. This will be day 1, this will be day 2, this will be day 3, and then they will reverse the market probably on day 4. But there are times when 1 or 2 levels are issued in the same day. Like for instance, they give you a peak formation low, push level 1 and level 2 in the same day, right? This is done in the same day. This is done day 2, right? Sometimes they can issue peak formation low, level 1, right? And this is 1 day. And then they can issue, this being level 1, they issue level 2, level 3 in the second day. So you have level 2 and level 3, and then you'll have a peak formation high, they reverse the market. The same thing is being done. But now the perfect example or the perfect market behavior is what you call the 33 trade. They issue those 3 moves in 3 days. And so you expect a reversal to be issued on the 3rd day or the 4th day. How does that happen? Look at this. So we get a consolidation or accumulation, all right, stop hunt low, right, or confirmation to go long. You get your big formation low, and then you have level 1 in day 1, consolidation and close. Then they will probably consolidate, stop hunt low, push level 2 in day 2, they close, or rather they consolidate and close, maybe pull back like that and close. And then day 3, they push down and issue level 3. And that is now in 3 days. This is level 1, this is level 2, this is level 3. 3 days of push. Now on the 4th day of the 3rd day, towards New York session, on the following day, London session, you'll be getting something like this, either intraday double top or macro, or rather what you call a multi-session double top, right? It can be a double top, it can be a triple top, or it can be a head and shoulder, I don't know. But the market will issue different patterns at different levels. But this is the same thing. So you have to know the 3-day cycle awareness, right? Where the manipulation is happening, accumulation is happening, where the manipulation and stop hunt is happening, and where the distribution is happening. This is distribution right here. This is distribution. So every day we'll have some sort of accumulation, which is happening during Asia, and then we'll have manipulation. Most of the time it's going to be London, and then you're going to have distribution, which is going to be New York, right? And the day closes. All these 3 things are issued every day, and you're going to get this kind of market behavior across all markets. It doesn't matter what you're trading. All right, but I hope you're following. I hope you're understanding these things, because if you're able to learn and master how the market makers manipulate you, how they manipulate your mind to make wrong decisions, then you would actually become a very good trader. Let's look at this chart here, right? So the market closes in consolidation. You can see it right here, and it also opens in consolidation. We get a stop hunt high, and we get another stop hunt high, and then we get a shift and a day 1 of drop. The market drops from here, day 1. We get another day of drop, day 2. We get another day of drop, day 3. And then the market holds, reverses the market. If the general market was bearish, they will have to reset the double top. And this is what was done here. Then again, we get 1 day of drop, 2 day of drop, 3 days of drop. The market holds, and then we reverse. Same thing every now and then, same thing every day. But can you tell what is actually happening in the market? If you can't tell, then you'll always be making mistakes, right? Learn to tell what is the reason behind a certain move, right? When the market is pushing towards certain levels, what are they up to? When they are issuing these big candles, do you actually realize how level 3 is always aggressive or big compared to level 2 and level 1? Level 3 is always aggressive, very aggressive. So that if anyone was holding on to buys from this confirmation to go long, right? Or maybe they were holding a buy, hoping that the market will reverse from level 2, then their accounts are wiped clean just before the market can come back and reset. Because otherwise we say your money is seated with your broker is of no use to them until you click that buy and sell trade, right? That's what they're after. They're after your money, and there's no other way you can give them your money if you do not click those buy and sell buttons, right? Now, the second thing, timing. How the market makers will use sessions, what you call session, or rather the work time indicator if you're using the BTMM indicator, the sessions. So this is, let's suppose, this is the day close or day opening, right? They consolidate during Asian market, right? Then just after the Asian closes, when they are going to issue a setup to either buy or maybe a setup to sell, right? Just after the Asian is closed. So this is probably towards London Open, or maybe during London Open is when they give you a setup to sell or a setup to buy, depending on what market you are trading at that particular point in time. So they will use sessions or timings. So just before this move happens, it will probably be beginning of London session, or maybe beginning of New York session, depending on how the setup has been played. Sometimes they will issue you during the entire London session. They are just playing out the peak formation low or the peak formation high. That's all they are doing during London session. When New York session comes, the market aggressively pushes up or down, depending on what London session was doing. But remember, we said this, Asian session is accumulation. right? London session will be stop hand or manipulation. They issue those peak formation or setups. And then New York session will either be distribution or continuation of the moves they initiated from the London session. It's the same thing every day. Same thing every day. The question is, can you see it happen? Can you be able to time your trades? Right? How the market plays out actually out of those manipulation boxes on your work time indicator. We are going to look at that shortly, right? Because it's the same thing, guys. It's the same thing. Now look at this. Let's assume the market wanted to take these prices down. And as you can see, we had a very aggressive drop here, right? We had a very aggressive drop. But how did they issue this? So during Asian market, we got a consolidation, all right, manipulation, right? And we get the first leg, right? This is during London, remember. Then high of London is swept. And just before this move is issued, the high of London is issued what we call railroad tracks. And then the market aggressively pushes down. Is this by mistake? No. The question is, are you able to tell what is happening here? Are we in level 3? Are we in level 2? Are we in level 1? Are you at a peak formation, higher peak formation low? Can you tell what is happening? Now, price action will always save you because look at this. Assuming you had noted probably there was a huge divergence on TDI, right? There is a huge divergence. Let's suppose this market is showing you that the market is going up. But on the TDI, we have something like this. You know, definitely you're looking for short position at the peak formation high, right? PFH. Peak formation high. So if you're looking for a sell, then the high of London, the high of Asia, yesterday's high, all these become key levels. Do you see how yesterday's high came into play in this during this reversal, particular reversal here? So we have yesterday's high is inside. We have Asian high right here. We have London high, and then they sweep all of it, right? Accumulate that money, and then they reverse with it. Now, if you are trading this market, and probably you can see the prices above the moving averages, when you see this big bullish candle here, it is normal that your thinking will tell you to go long, and your stop loss probably will be below this candle or below the moving average or all the way below here. But it doesn't matter because you can see immediately this big candle was issued, an equal opposite candle was issued, and the market actually reversed towards the downside. This is why it matters for you to understand levels. It matters for you to actually be able to tell what the price is doing. You can read those candlesticks form as they form and as they move. You can tell what is happening, right? So they aggressively push down, they push down. And if you are putting a stop loss here, within, I think, 2 candles, you had already been swept, right? And you're now like, maybe this is not for me, right? So you have to be able to tell what is happening in the market for you to be able to catch those moves before they happen. Right? Don't enter too early, don't enter too late. Number 3, psychological levels and ADR. Now, what are those psychological levels? So let's suppose we have a peak formation low. I'm assuming the market is going to, or rather the market is bullish. So we have a peak formation low. We want to be looking for buys, right, at the low. It's going to be either daily low, right? Or maybe it's going to be Asian low, or maybe it's going to be what? London low, or maybe it's going to be yesterday's low, right? All this can be in play. Today's low can be a level, Asian low can be a level, London low can be a level, and then yesterday's low can be a level, right? All these things at the same time can be in play. Now, I want us to look at something. Now, let's assume you're trading in this market and you are supposed to go long, you're looking for buy opportunities, assuming, right? So if you are looking for a buy opportunity, then it means that Asian low is where you're supposed to be looking for a trade. And this is where it's being issued just before London open. And if you caught this trade right here, then you could have been able to enjoy this profit right here. Then here, right at the interchange of London and New York, that's where you're getting your setup to actually go short, right? Now, this is why these key levels, right? Yesterday's high, London high, that's where it is. So all this is money lying here. And that's why your key peak formation high was issued right here at the high. So if you're going short, you want to use the highs. You're going to use yesterday's high, today's high, London high, Asian high, New York high, even if it matters to you, right? That's where you're going to get these setups. And then the market actually goes down. The same thing, guys. I hope you can see it. I hope you can learn something from here. I want us to look at number 4, TDI and EMA Confluence. So many times when the market is giving you a trade, there is going to be some sort of communication between the price, the charts, the moving averages, and the TDI. So maybe on the chart, you will have maybe a peak formation high, be forming, something like this. That's what the chart is showing you. And maybe the moving averages, they can show you something like this, right? They can show you something like that on the moving averages. Then at the TDI, you'll have something like this. Right? So here we have the RSI price line creating a first leg that is higher than the second leg. And then the market shows you that you have a double top. Yes, only that the second leg is lower than the first leg. This is the TDI, remember. This is the TDI. Then on the chart, The first leg is shorter than the second leg, meaning that this here is actually a stop hunt to the high so that the price can go down. And this will always be present. Now, let's look at an example here. In this case scenario here, we have the price showing us some very beautiful setup right here, right at the key levels. So we can see here, this is London high, and then these are your moving averages here. The London high is swept with a railroad track, but at the TDI, if you look at what is happening at the TDI, the first leg is right here, right? If you look at it, that's your first leg. So you can see on the TDI, it's higher, right? But on the chart, it's lower compared to the second leg. On the chart, it's higher. On the TDI, is lower. So once you get a confirmation could be the close of this bearish candle after the sweep of London high, or maybe once the market closes below the 5 and 13 EMA, you can also go short right there. So you have several confirmations to go short, right? If you look at the TDI, the RSI green line crosses below the red line, and it also crosses below the particular market baseline, which is the yellow line. So this becomes a very nice trade to take short or going down, because you have all the confluences. So you have the moving averages, you have the levels in play, you have the timing in play, you have the candlestick confirmation or price confirmation in play. All these things come into confluence. And so you're able to get your sniper trade from here. If you're trading executing your entries from this high here, you get several discounted prices for you to execute your trade. Many people make mistakes because we have these aggressive pushes towards the downside and the market is going down. They are going to be selling even from here. Then the market is going to frustrate you and close with you inside. Disrespect your rules, not to take trades too late, just because you're too greedy, you want money. Now look at this, right? Look at this. Tell me whether it's by mistake here. So we have the market issuing the first leg. You can see it right there. And this is the first leg right here. And then the second leg is issued, only that it is lower than the first leg. Look at this, right? So we have the market, the TDI going up. Then on the market, we can see, or rather on the chart, we can see the market is going down. This here is a divergence. And then you can see how they repeated this 3 times. So they hit it once, they hit it twice, they hit it 3 times, they shift it, and they push the price higher. This is what you're looking for, right? You're looking for this kind of divergence, some sort of communication between the TDI, the moving averages, and the price itself. So here, you're getting this particular nice communication. The moving averages are pushing, then we get it below again, they go up, and then they go down, they go up, and then they push higher, New York session, right? So this is not by mistake, but you have to be able to tell what is happening. You have to interpret the chart against the TDI and against the moving averages. That's the only way you're going to be able to tell what is happening in the market. But if you have issues telling what the price is doing, then there's no way you can tell that you're going to be outsmarting these people when they're issuing all this kind of garbage and you're taking everything, right? So you don't need to outsmart the market. Just stop walking into those traps. Stop trading, taking buys at the high and sells at the low. Do the opposite. Do the opposite. So we are looking at a market that has given us a big formation low. We are looking for every low, right? Every low. And every low could be yesterday's low, could be today's low, could be Asian low, could be yesterday's low, could be London low. All these are going to be key levels. Could be ADR low, could be psychological levels low, right? And then maybe we have a big formation high. You're going to be looking at the highs. It could be yesterday's high, right? It could be Asian high, it could be London high. All those things are going to be key. Now let's go back just a bit. Maybe I'm taking you too fast. So if I'm looking for a sell, then I'm going to look for a level where I have yesterday's high as a key level. We have London high as a key level. And then we can see some sort of structure forming, right? We can see some sort of structure forming at a key level and at a time when I'm able to time. This is now the New York session. The pattern is issued in during the first leg is issued during London, second leg in New York, and then you're going to take your trade. But you see, something is in play, right? We have Asian high, we have yesterday's high, and we have London high. All these levels have liquidity. So here you get a very key level to deal with and take your trade. So the moment you're issued with a pattern, this becomes your confluence. It becomes your confirmation to go short. Now, if you go short right here, or maybe right here, latest, meaning that you have really disregarded all these entries, right? Latest you can get is right here, right? Then you go all the way probably to the Asian low. Book your 50 pips and repeats depending on how aggressive the market is for that particular day, right? Now, assuming you are buying, or rather you're not doing the opposite. If you're buying, then you want to look at the lows, right? The market is supposed to give you a buy setup. Then you're going to look at the most lowest level that you can be dealing at, where there is liquidity. Now, for instance, if I'm looking for a buy, I'm looking for yesterday's low, I'm looking for ADR low, I'm looking for Asian low, I'm looking for a London low, and any other level that is lower where the liquidity could be lying, right? So here we get a trade, but it is issued right at London low. You see this? This is London low, and this is where you are issued with a pattern. One thing you must realize is that even though London had issued a pattern, here it is on the TDI. It's very low compared to this leg, which is lower than London, but on the TDI, it's higher. But you see where it's appearing right at the London low. So this is a key level. This is where the liquidity was. So it becomes your confluence. Look at this one here. So we have yesterday's low in play. We have London low in play. We have the first leg, the second leg. There you are. You get your peak formation low and you push the prices back to the 50 or 200 EMA. Same thing. Same thing. Look at this one here. So here we are getting a sell, right? So we have the Asian high, manipulation high. We have the London high right there. And then you have a key level, which is the 200 EMA. Right? You get your peak formation right there. You can go short right there. You can go short right there. Right? And you have a very nice move towards the downside just before you get this reversal. Same thing done every day. Question is, can you be able to see it? Now, spotting the traps before they happen. Now, you want to see price sweep the Asian high or whatever level it is. It could be Asian high, London high, but at a session open, could be London, could be New York, or it hits the ADR high, it could hit the psychological high, it could be yesterday's high, they hit that level, right? Then there is a TDI crossover and an EMA structure shift, right? Something like that, right? Where the market is telling you this, but then at the TDI, you have something like this. This is communication. This is what you're looking for. And this, remember, is for sell setup. Now, for a buy setup, you want the opposite. So you will notice how the market begins to move. Only after retail traders are trapped, okay? And that is going to be your moment because you'll have identified it happen. Right? What are we trying to say? Look at this one here. So this here, we have multi-session intraday double top. Look at this. You're going to see it. So here we have yesterday's high. It is being swept with a very bullish candle. If you're coming to trade the market right here, you could have executed your buy right here because you're seeing this aggressive. Not knowing is actually a stop hunt of the high, right? And then you get the market issuing you with a double top. So you could have executed a sell on the close of this red candle here, or on the close of this, or just the moment when the green, the 5 and 13 EMA is crossed over, right? So this is your entry. This here is also an entry, right? New York session, you're given another entry. Look at that, a double top right at the 50, or rather what you call the ID 50. And you could have taken this trade right here, stop loss above the New York session high, and the market dropped the following day aggressively. But now, that's not the issue. Look at the TDI. Maybe we are talking too much. Look at the TDI. So here we have equal highs, but at the TDI tells you it's going down. So even though this high is equal to this one, at the TDI is extremely low. And at the TDI, you have a perfect M formation, even though here you're being given an extended leg, but the TDI you have equal highs. Now you see, again, it never fails. Communication is still the same. So you could have executed yourself right here and hold it, right, until probably the following day, or maybe when you realize some good amount of profit, right? So, but it comes out of a lot of practice. I won't say that because you've watched my video and it's now going to be very simple and easy for you to spot it. You need to go and do some practice, back test, look at the charts, ask yourself what happened here, right? Why did they move this way, right? Once you start questioning the charts, things are going to become easier when you're trading live. You won't have issues when the setups are being issued. You will know whether there is real volume in the market or not. Okay, so your new trading mindset, trade like the market maker. Ask yourself, who is being trapped right now? Where would a market maker enter or exit? Second question, most important, is the move too obvious? If it is too obvious, or if you get a setup that is so good, right? And you just immediately enter even without asking yourself questions or without questioning the setup, right? I'm going to tell you something, my brother. Get ready because you're about to be sexually molested. The market doesn't give easy things. You just come and find, you know what, we have a very big bullish candle, so the market is going up. You execute your buy and the stop loss. My brother or my sister, the market will just issue you an opposite candle and sweep your stop loss. Probably you are those kind of guys who are doing full margin trading. And so you are going in with your 100% of your account right here just because you've seen a big candle. My friend, this is going to happen to you. And I don't want that to happen. So if the move, or rather if the candle is too obvious, ask yourself questions. What is happening? Is the market up to something to hit a certain level, then reverse? So don't take it. Ask yourself, why is the market pushing to that level? Because there must be something that they are after. So BTMM isn't about some fancy tools. It's all about shifting your perspective into seeing what is moving the price to certain areas, to certain levels. And all those things are going to come in handy when you're trading in your live account. Because now the emotions, the fight, the struggle about making trading decisions will not be there. You'll be actually interrogating your setup. You'll be asking yourself questions before you take that trade. And it's going to save you a lot of money and a lot of time. Anyway, thank you so much for taking your time to watch this video. I really appreciate it. And I hope to see you in the next one. Keep profitable, keep trading.